Bond vigilantes, you will die a terrible death. Jason Zweig is here to tell us about how the bond vigilantes are wrong. The bond market perhaps a bit different than people perceive it, and that has significant repercussions for so many aspects of our economy.
Absolutely.
Jason, you have a great column in tomorrow's Wall Street Journal. Tell us about it.
Yeah, it's a big deal for savers, Dennis, and it's a big deal for, the biggest bond market around. It wasn't that long ago that well over half the U.S. Treasury market was owned by people we would recognize as investors, not just households, but professional investment firms. That's down to less than a quarter of the holders now.
Okay, so now professional investors, who would you put in that category? Hedge funds?
Yeah, well, we're being generous when we call them professionals, but yes, hedge funds, pension funds, everybody who manages money for a living.
Right.
And now the sort of the single biggest block of holders is foreign holders, largely central banks. And these are people who don't care what treasuries yield. They're owning them not to get an investment return, but for safety and, of course, to hedge the risks of their own currencies or their own banking systems.
Right.
So when you throw all that together, you go from a market that used to be very sensitive to what bonds yielded. And when the government got a little reckless, people would step in and say, you have to stay in line and you have to manage yields. So
this is what we're seeing across Europe, right?
Exactly.
The vigilantes are alive and well in Spain and Italy and certainly in Greece.
Right. But over here, they've disappeared.
And so for you, this has created, I don't know if you would call it an unnatural market, but certainly a different market.
Yeah, I mean, the sort of the safe money bet, if you talk to anybody in the markets, is that interest rates in the U.S. are going to stay low for a couple more years, and then they're going to revert to normal.
That would be my guess.
That would be my guess.
A 1.6% yield on a 10-year bond does not seem normal.
No,
it just doesn't.
No. But one of the problems is if the bulk of the Treasury debt is held by people who don't care what it yields, then the government has the upper hand in determining what the yield will be, and there's a lot less market discipline.
Well, it seems, Jason, that your theory holds up as long as that one phrase you just said, as long as they don't care what it yields.
Right.
And why are you confident, say, that the Chinese central bank isn't going to do something else with its money, perhaps pour more money into investment into private companies, for example, or will be another example. And the Australian central bank says, we'll just keep this money here rather than putting into U.S. treasuries.
Well, that certainly could happen. I mean, all trends eventually reverse, but it certainly isn't what we've seen the past 3 or 4 years. I mean, we've seen money continuing to flow from price-insensitive buyers into treasuries. And it almost certainly makes it easier for the U.S. government to impose financial repression, to keep rates really low.
That's a very strong word, financial repression. Tell us why you use it. Or someone's quoted in your story uses it.
Yeah, I mean, it's a phrase that's been popularized by Carmen Reinhart, who's an economist in D.C., and it basically refers to the idea that one of the best ways to get out of a financial crisis, once the government assumes all the debt, is to force negative real interest rates onto the investing public. Just to say, we're going to push inflation up a little, and we're going to inflate away the debt and make it easier to pay off that way.
Right.
Instead of being financially responsible, we're just going to be financially repressive.
Right. And so, from your perspective, it seems like the tools, or maybe not the tools, but the conditions are in place, perhaps for a lack of that come to Jesus moment for Congress, for the presidency, for the American people at large to understand we need to get our debt and our fiscal spending in check.
Yeah, I mean, if this trend holds true and it lasts for more than another couple of years, it gives policymakers a window to continue doing the wrong thing and to keep kicking the can down the road. And investors just shouldn't be too complacent about assuming that just when they need the most, yields will come back up. They might not come back up for a while.
Okay, well, that's some discouraging news.